Everything that you have been hearing in the news lately is all about the United States debt ceiling, and it could be absolutely catastrophic.
If this debt ceiling would not be resolved, it would be financial Armageddon.
It prevents the worst possible crisis, a default for the first time in our nation's history.
But what the mainstream media is not telling you is the real problems begin when the debt ceiling is raised. I'm going to explain this to you in one simple, fast step. Let's go over this liquidity crisis that we could see once the debt ceiling is actually raised, once the problem is quote unquote solved. We're going to start by going over some balance sheets. We've got the government, the Fed, banks, and non-bank entities represented by everyone's favorite, the average Joe. So on the left, we have assets, right, liabilities. With the government, we're going to have bank reserves as an asset, liabilities, treasuries. Okay, Fed, those assets are going to be treasuries, mortgage-backed securities. Now, what's interesting, what I want you to note, is these bank reserves that are an asset of the government, they're actually a liability of the Federal Reserve. They're in an account called the TGA, Treasury General Account. All right, other liabilities would be bank reserves, but those aren't assets of the government. Those are assets of the commercial banking system. The same types of bank reserves. They're absolutely identical. On the bank's balance sheet, we've got those reserves we were talking about, and we have loans. Everyone knows how the majority of dollars are created. They are lent into existence from the commercial banking system. And on the average Joe's balance sheet, we got a couple bucks there. And on the liability side, we got loan and we have the mortgages that the Fed, there we go, has on their balance sheet in the form of mortgage-backed securities, or what I like to call them, mortgage-backed sausages. Okay, so this is all pretty straightforward, but what happens once the debt ceiling is raised? Well, Janet Yellen, I forgot to put her name here, but you can tell by my incredible artistic ability that that is obviously Janet Yellen. She has said that she wants to fill up the TGA because it only has maybe 10, 20 billion dollars in it right now. She wants to fill it up to, who knows, 5, 6, 700 billion dollars. And she wants to issue $1 trillion worth of T-bills into the market once the debt ceiling is raised. So this would be a deluge of supply, a tsunami of bills hitting the market in a very short period of time. All right, well, let's think this through. Let's go to the balance sheets and see how this would work as far as the mechanics and the plumbing. So what the government is going to do, they're going to add treasuries to the liability side of their balance sheet because they're trying to fill up the TGA and get more of those bank reserves. Okay, makes sense. So what the Fed would do, assets still the same, but they're going to take the bank reserves from the commercial banking system and move them down into the government's account. Okay, well, why on earth would they do this? All right, let's say that Janet Yellen is issuing all these T-bills here. She's making it rain. And the non-bank entities in the real economy, like the average Joe, are buying those T-bills. Hence this black arrow going right over there to the average Joe's balance sheet. So now he's got those dollars that he had to begin with, but he's traded some of his dollars for those T-bills that he just purchased. Okay, so what happens to the bank's balance sheet? Well, what they do is they actually go over to the average Joe's account and they delete some of those dollars that were there to begin with. Okay, well, that's reducing the liability side of their balance sheet. But what else do they have to do? They have to transfer those bank reserves down from their account into the account of the government, the TGA, on the Fed's balance sheet. So their balance sheet, the banks, is actually contracting. But wait a minute here. If the bank's balance sheets are contracting, that means they have fewer bank reserves. They have less liquidity. And we all remember what just happened with Silicon Valley Bank, Signature, First Republic. They had all these deposits leave. They didn't have enough cash. They didn't have enough bank reserves, and they went bust. So basically, how this works is the government sells all these T-bills, $1 trillion, I think over the span of about a month, a very short period of time. All these non-banks buy. So this contracts the bank's balance sheets. We see that right here. And if it contracts the bank's balance sheets, that means they have fewer bank reserves. They have less cash because those bank reserves are going into the TGA, right here, the Treasury General Account. That's how Janet Yellen is filling up what is effectively her checking account. This creates a liquidity crisis. There's not enough reserves, cash in the system. Banks go bust. Stocks could collapse. We get a 1930s type of Great Depression. And oh, by the way, rates would most likely explode higher. Why? Because she's issuing $1 trillion worth of supply into the market. Well, how is that going to be soaked up? Most likely, yields go up and prices go down, which would require the Federal Reserve, the central planners and authoritarians, to come in and do yield curve control because they've got to keep those interest rates artificially low because they know the economy can't handle the higher interest rates created by this deluge, this tsunami of treasuries that have been thrust upon the market by, obviously, Janet Yellen. So then the question becomes, how would the Federal Reserve implement yield curve control? How would they buy all the bonds that they would need to buy because of the supply-demand imbalance? Well, that's when money printer goes burr. They would have to create all of this money, all these new bank reserves, and that most likely leads to the dollar crashing. And that's why the real problems begin once the debt ceiling has already been raised. And now I'm going to tell you why this entire theory is complete nonsense. You weren't expecting that one, were you? Editor, help me out. As usual, the devil is in the details. Let's look at the Fed's balance sheet again, but this time we're going to use a little more nuance. So it is true, the banks have these accounts, the Fed. In aggregate total, right now, they've got about $3.2 trillion in bank reserves. The TGA is getting a little sparse. Last time I checked, about $60 billion. It could be even a little bit lower than that. But they also have another account that is a liability of the Federal Reserve. This is what they call RRP, or reverse repo. And typically, this is what a lot of the money market funds use to go ahead and park cash. So right now, that balance in aggregate total is $2.2 trillion. All right, but it's important that we go over this in even greater detail. So like I said, right now, the bank's aggregate total balance right around $3.2 trillion. To give you some context, about the same as we had at the beginning of 2021. Okay, so if liquidity to a certain degree for banks, according to that theory that we just went over, has to do with the reserves relative to the deposits, well, we've got to see what the deposits were back then and make some comparisons. Okay, so the deposits at the beginning of 2021, about $16.3 trillion. Today, $17.1. So they have gone up by, call it, $800 billion. You could say, okay, George, well, that ratio is getting smaller. Therefore, we could be having a liquidity crunch. Right. But let's go back to 2019. And I'd like to point out that prior to the cerveza sickness, this ratio, or the percentage of reserves that banks had relative to deposits, was about 12%. So now at 17%, it's much higher than it was before. Why is this important? Because it shows you there's most likely a significant buffer. But let's go ahead and take this one step further. Like we said earlier, the concern is that all these non-banks will start buying, and that reduces the amount of bank reserves significantly. All right, but if the amount of bank reserves are going down because banks are taking those bank reserves and putting them into the TGA, something that would look like this as an example, then that means those same banks are reducing the amount of deposits they have as well. So if we had, let's say, $440 billion of reserves go into the TGA, then the commercial banking system would go from 3.2 down to 2.76. But their liabilities, those bank deposits, would go down by the same 440 billion. And it is true, this may go down slightly, but it doesn't take us anywhere near where we were when liquidity was not a problem at all. I know a lot of you that are really paying attention are saying to yourself right now, okay, George, yeah, I get how this works, but you're the one that says the devil is in the details. So let's look at more nuance with the commercial banking system. You're looking at aggregate totals. That's fine and dandy. But what about when we compare mid-size and small size versus these mega banks? We know that the regionals are really walking on thin ice. When the JP Morgans, the Bank of Americas, the Wells Fargos are flushed with reserves or flushed with liquidity. And this is a very good point. But let's assume for a moment that all of these treasuries, 100% that Janet Yellen issues in a very short period of time, are purchased by not just non-bank entities, but non-bank entities like the average Joe that bank with those mid and small banks that right now are walking on thin ice. Okay, well, what happens there? Well, the reason that the average Joe, the non-bank entity, would want to buy one of these T-bills in the first place is because they can get more money than they can, well, I don't know, with one of these money market funds. It will just park it in reverse repo. So right now, reverse repo is paying about 5%. So let's just assume for a moment that the yield on these T-bills, just pick one, goes up to 6%. So the average Joe then has an incentive to say, whoa, why am I parking all my cash in this money market fund that's just putting it on the Fed's balance sheet when I can go ahead and buy these T-bills and get an extra 100 basis points? Right? That makes a lot of sense, doesn't it? But the fund manager that manages this money market fund is seeing the exact same interest rate. And you can tell how greedy he is just by the fact that he's got dollar bill signs for eyes. Tells you everything you need to know. In other words, if the average Joe is thinking about that opportunity, the fund manager, I can guarantee you, is going to beat him to the punch. Okay, so what happens then? Let's look at this other example of the balance sheet. So in this case, that 500 billion or the extra 440 would not come from bank reserves. It would come from the balance that's currently in reverse repo. So, or we can go up here. So 2.2 trillion right now in reverse repo. Well, if all those fund managers beat Joe to the punch, then they're going to draw down this account because they can get a little bit higher interest rate just buying those T-bills. So the bank reserves wouldn't come from the bank's balance sheet. The bank reserves would come from the balance sheet of the money market funds. Another super simple way to think about this is the money market funds or reverse repo would suck up all of those bills. And therefore, Janet Yellen would get her money directly from reverse repo. And therefore, the amount of reserves banks had in total wouldn't be affected at all. Oh, but wait, there is more. Let's assume for a moment that all the big banks do the buying. The JP Morgans of the world. Okay, well, how would that impact the Fed's balance sheet? Well, same thing as this example. The reserves would go down to 2.76 trillion. TGA would go up to 500 billion, and reverse repo wouldn't be impacted. All right, well, we don't have to worry about a liquidity issue with the JP Morgans of the world. Why? Because they're flushed with bank reserves. So that is a complete non-issue. Also, I'd like to pose a question to all of you watching this video right now. For one of these big banks, what is more liquid as far as an asset on their balance sheet? A bank reserve or a T-bill? Editor, go ahead and cue the Jeopardy music. Most people would say, well, George, I don't really know, or maybe they're the same, but if you're very sophisticated, there's a strong argument for saying the T-bill is actually more liquid. And the banks would prefer to have those T-bills above and beyond just plain old bank reserves that you can really only utilize in the domestic economy. Those T-bills are good as gold pretty much anywhere throughout the global monetary system. Oh, and wait, there's just one more thing. Let's think about what a T-bill actually is to a big bank. All it is bank reserves that you're going to get in 1 month, but you're getting paid interest. So my point is all a T-bill actually is to one of these big banks is just simply bank reserves that they'll get paid in the future, plus a little bit of interest. So how can you argue that if these big banks are swapping out reserves for T-bills, it actually reduces liquidity? It makes no sense at all. Now, let's also remember the primary dealers themselves may come in and buy a lot of these T-bills. Okay, well, if they buy a lot of the issuance, that means there's going to be, let's say, an extra $500 billion of T-bills or collateral on the balance sheet of these primary dealers. Why is that important? Because that's an extra $500 billion that they can rehypothecate. That's more collateral in the system. And there's a strong argument that because we have a lot more T-bills, therefore a lot more collateral, this would actually increase the overall amount of liquidity. But the main thing you need to take away from this entire video is the fact the banks themselves produce liquidity. This is their job. This is why they exist, to loan money into existence. And they don't just loan you money for a mortgage or an auto loan or maybe your credit card. They also loan money, create cash for other banks themselves. So what we really have to get our head around is the idea that the Fed is not the sun in the monetary solar system. Most people think the Fed is the sun and the banks kind of are a planet that just revolves around the sun. But it's actually the opposite, that the banks themselves are the sun in the monetary solar system, and the Fed is just simply revolving around the commercial banking system. So, what's my point? It's that when you're looking at liquidity or a lack of liquidity, the most important thing to consider is right here, counterparty risk. Because if the counterparty risk or perceived counterparty risk within the commercial banking system is very low, then I can assure you liquidity is going to be very, very high. So the question becomes, if the debt ceiling is raised, meaning if the government is no longer at risk at defaulting on their debts, causing Armageddon and the whole world to come to an end, is there less perceived counterparty risk or more perceived counterparty risk? I think the obvious answer is that there's a heck of a lot less. And if there's less perceived counterparty risk, then that means you would expect to see actual liquidity go up, not down. Let me be very clear. I'm not making a prediction here. The purpose of this video is to give you both sides of the argument and to give you a lot more detail and nuance than you're getting just on FinTwit, social media, or in the mainstream media. But you've got to come to your own conclusions, not based on certainty, but as always, based on probabilities. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here. I will see you on the next video.